Good morning, everyone, and thank you for joining us for this today Mediterranean and African webinar. My name is Antonella Vona. I'm the Region Communication External Manager for the Mediterranean and Africa. I'm glad to see so many participants today, and as Coface, we are glad to support you with economic outlook and also a lot of publication. I'm pleased to introduce our today's speakers, Marcos Carias, Coface Economist for Eurozone, Seltem Igun, Coface Economist for Middle East and Turkey, and Bruno Fernandez, Economist for Western Europe, Spain and Portugal. Before I hand the mic to Marcos, I would like to tell you that a recorded version will be available after the webinar and also the presentation. We will have at the end of the session Q&A question that you can submit anytime during the presentation via chat. I would like to tell you that the session, our presentation will last 40 minutes and after we will have a quarter for a session of question and answer. Without any further ado, I invite you, Marcos, to take the floor. Thank you.
Thank you, Antonella, for your kind introduction, and thank all of you participants for being here to take stock with us at the state of the global economy and what this might imply for our region, for firms in our region. I think it's a good moment to take this perspective at the global economy because we have encouraging trends on one side. We've had on the side of activity a very positive, I think, 2021. Even if some sectors of the economy that are important to our region, such as tourism, are not quite back in shape, we would say the coronavirus is still being a factor, even if we are looking more towards the end of the pandemic than the beginning, unless something bad happens with a new variant. But for the moment, our baseline scenario can be that we are looking more to the world after the pandemic. But we've had a very encouraging activity year for the manufacturing sector. And going outside the realm of the pandemic, we also have this very problematic trend of commodity prices soaring, transport costs soaring, the availability of many key materials and inputs for production not being sure at all. So obviously this creating a lot of uncertainty for firms in the manufacturing sector, and also questions about what this might imply for inflation. Inflation had disappeared for a long time from the public debate, but now it's coming back. So thank you all for being here. We will first start looking at a global look at the Eurozone with some focus on the Southern European economies, Italy, Greece, Spain, Portugal, and then we will go to the Middle East and Turkey region. So when we look at the economy, the first thing to look at, as always, is the state of vaccination. And the good news on this side is that the European countries have, during the summer, been very successful at running vaccination campaigns, forgetting the lags that we had at the beginning of the year. We were talking about how the United States, for instance, had a very successful campaign where Europe had logistical problems in implementing vaccination campaigns. Well, that is no longer the story, and actually European countries, most of them are actually leading the race towards herd immunity. And the very good news on this side is that this allows us to decouple the epidemiological curve from the activity curve. Now, the main danger here is that emerging countries are lagging a lot in terms of vaccination, and so what this does is that we cannot completely discard the risk of some kind of problematic variant being some variant that would be either resistant to vaccination or more deadly or more contagious that would require stronger containment measures. Well, this is not yet the case, so this is a downside risk to a scenario, but not something that is happening yet, so we can continue to be optimistic on this front. So taking this into account, when we look at our perspectives for growth in 2021 and 2022, things look fairly optimistic. We know that in Europe, we have a lot of fiscal spending going on due to these European funds that we know are very strongly channeled to activity in Southern Europe that are being very supportive of investment, both public and private investment, because a lot of these projects are public-private partnerships. So we can expect pretty strong growth rates for both 2021 and 2022, around 5 or 6% for most major European economies. And Europe will therefore be one of the main engines of growth in 2022. So I think that it's very important to take into account when we try to explain these trends that we are seeing in commodities is that the recovery of the global economy has been a lot more sudden this time around when compared, for instance, to the last crisis in 2008, 2010. The recovery was a lot more gradual. And what this causes is that, well, we have all the major economies in the world rebounding more or less at the same time, putting a lot of demand pressure. And on the side of supply of raw materials and inputs, well, supply is a lot less fast to adapt. So this mismatch between supply and demand is essentially the main factor explaining these rising supply shocks, these trends in commodity prices and energy that we're seeing. And this is important to take into account because as the Chinese and American economies slow down a little bit towards the end of the year and next year, well, this should mean less demand pressure on all these prices, and so we can expect a little bit of moderation next year. One important risk to take into account of the global economy right now is what's happening in China. I'm sure you've all heard about Evergrande and the debt situation over there. And while we think that Evergrande itself might not be as risky as something for the global economy, you do have to take into account that the Chinese economy has been running on debt for the past 10 years now, pretty much. So what you see in this chart is private credit as a percentage of GDP in China and how it started to grow after the 2008 crisis. And this is very concentrated in the property sector, which is now 25 or between 25 and 30% of GDP, depending on how you measure it. Now, the Chinese authorities are realizing that this is a major risk for the economy and have started to clamp down on it by restricting credit. And what this is important to take into account is that this might mean that we see lower structural growth rates coming out of China as of, let's say, 2023, 2024. It will be harder for them to achieve their 6% target, and this is something that exporting firms have to take into account. So the big news in recent months has been what's been going on the side of gas. We know that Italy, for instance, has an energy mix that is very reliant on natural gas, and Europe has been very lagging in constituting their stocks of natural gas this winter. We had this summer, what we're seeing right now is most probably this pressure for restocking this because we are expecting a winter, and the stocks that we have right now are not enough to supply that. So natural gas prices are skyrocketing right now. There might be some degree of moderation later in the year, but of course, a big risk for that is always climatic conditions. If we have a winter that is more aggressive than expected in Europe, in Russia, these pressures might continue to be a drag, especially for the manufacturing sector and for heavy industry, which we know is very reliant on energy for their activity. More broadly, this is part of a larger trend in input prices for many types of inputs, raw materials, transport costs, which have been multiplied by a factor of 4 since the beginning of the year, and which is starting to have a substantial effect on margins of producers. Now, like I said, as the major economies of the world start to slow down a little bit, I think we should see some moderation towards the end of the year, beginning of 2022. But of course, nothing is sure in these trends. Now, we're already seeing some signs of moderation in wood, in steel prices, for instance. But we do expect these prices to remain above 2019 levels throughout 2022. So things will get a little bit easier towards 2022, but the situation is not over. And this is, I think, especially the case when we look at an input like semiconductors. What you see here on the left is a survey done in Germany about in each sector the percentage of firms that are declaring this to be a major problem. We have seen this percentage rising toward the year along the year, and being especially prevalent in sectors like electronics and automotive, which are seeing some significant cuts to production, and especially in the automotive sector and for automotive suppliers, this is a major factor of risk, and this is why we remain very vigilant about this sector. So coming to the subject of inflation, first thing that I would like to say is that the situation is not the same in the Eurozone as it is in the United States. We're looking at 5% inflation rates in the United States, and these are quite a bit lower in the Eurozone. And we do subscribe to this narrative promulgated by the European Central Bank that inflation should be essentially transitory. Of course, this is not a certainty, but is the baseline a scenario as of now. We, of course, have to remain very vigilant to the month-to-month monitoring of prices of the economy. And it's important to take into account that when we talk about inflation, we are talking about price of consumer goods. This is the price that the ECB reacts to. And something important to take into account is that even if raw materials are rising by a lot, and even if producer prices are rising by a lot, the transmission of these prices to consumer prices is not one-to-one. What you see in this graph, on the left-hand side, for instance, is that yes, raw material prices are rising by a lot, but it's not the same. It's not the first time in history that we see these huge rises in raw materials. That is on the blue curve, and what you see on the orange curve is that, well, producer prices tend to be a lot less volatile than raw material prices. And the same thing holds when we look on the right, when we compare prices of producer prices and the evolution of consumer prices. There too, the transmission is not one-to-one. So we do expect these supply pressures to transmit to inflation, but not on the same scale. Now, I do want to talk about the risk of inflation and debt in the Eurozone, because if we do find, it's not impossible that inflation will prove to be more durable than we are currently anticipating, and that will be a very problematic situation, especially for the ECB. Why? Because they will be trapped between respecting their price stability mandate and respecting their job to prevent financial crisis. Because if they have to lift rates to fight inflation, that will also mean increases in refinancing costs for states that are very indebted, companies that are very indebted, and so it will put some very strong financial pressure on the most indebted actors in the economy. If, on the other hand, they don't want this situation and they keep an accommodative fiscal policy, monetary policy, well, this will create some political tensions within the Eurozone, especially coming from countries that are very averse to inflation, such as Germany and other more conservative countries. And this can, jeopardize the political stability of the Eurozone, which will also rise the political premium for financing costs in the Eurozone. So that's inflation, we have to remain alert, not yet be alarmist, but know that if inflation rises to, let's say, 4 or 5% levels, that would be quite dangerous. On the side of corporate insolvencies, we are still in that situation of insolvency suppression. They are still very low when we look at the figures in Italy, for instance, compared to 2019 levels. We expect these levels to rise in 2022, although maybe not as much as we used to. We think that budget measures, fiscal measures have been very strong in saving a lot of companies, and obviously we cannot only go up towards more normal levels of insolvencies, but this narrative of a wave of insolvencies that we used to believe a lot more towards the beginning of the year, I think we're a lot more positive about it, at least in the European countries that have invested a lot into saving companies. So I will just end by giving a little bit an overview of Greece, because I think this is an economy where a lot of things are happening, especially on the investment side. Like I said, a lot of European funds are being invested here. They will be disproportionately invested in sectors like ICT, because a lot of this is going into the digitalization of the economy. The government there is very serious about modernizing the digital infrastructure of the country. Also, physical infrastructure, construction sector will benefit a lot from the allocation of these funds. So the Greek economy has been very reliant historically on tourism, as you can see on the graph on the left. Well, tourism is recovering, but will still remain below 2019 levels. Exports, because these are a lot of the exports of Greece in 2022, but this will be very compensated by what we are seeing on the side of investment. This will be it for my side of the presentation. So I will leave the floor to my colleague Bruno, who will look at Spain and Portugal.
Thank you very much. Now the floor is yours, Bruno.
Do you all see my screen?
Yes.
Yes. Okay, so I'll take you to the peninsula. So, and we'll start in Spain. So, well, as Marcos has shown you, basically, Spain was the most affected country in terms of economics in 2020, with a decline in GDP of 11%. And well, if we look right now at the GDP level at the end of the Q2, the last figures we have, I mean, basically all the major European economies are around 3, 4, 5% below the end of 19 levels. But Spain is 9% below. So it means that Spain is lagging behind the rest of the major European economies in terms of recovery of GDP. And now the question is, of course, why? It's what we are trying to understand. And there are two main answers. The first one, when we look at GDP expenditure components, basically, you can see that almost all the components, well, except the government spending, of course, because of the support measures, because of the spending in health, for instance, during the crisis, all the other components are almost near to the pre-crisis level. Two exceptions. The first one is the investment in construction, and we'll talk about that later. And the other one is the exports. But when we talk about exports, it's not about good exports, it's about services exports here. And so about tourism. And when we look at the chart at the right, we see that too. It's like the construction sector is still far from the pre-crisis level, and also the here is the hospitality, not that much the trade or the transport, but more the hospitality sector. And now if we move to the other slide to try to understand how have behaved these two sectors, first the construction one. The construction sector, as you can see, basically the building permits are recovering quite fast, but I think that there are two different trends. The first one is the residential one, which as you see, is already higher than before the crisis. So we can see that households are investing in new houses. Well, we can also think that the fact that many people will work from home, that it will be a lasting trend, will help maybe the construction sector with people trying to invest in maybe bigger houses or different houses with a garden with more space, right? And then the other side, maybe the side which has suffered the most is the non-residential segment. And when we look at which kind of buildings are doing the worst, is the offices, and we think that it won't change that much because, of course, with the working from home, companies will need way smaller spaces, not that big offices. So we don't expect them to recover that strongly. And the other point is the commercial one. And well, regarding to that topic, we know that, for instance, with the online sales increasing and the online segment increasing, it will be maybe difficult for the commercial segment to recover fully. But well, we see also that it's on the rise, and so that the construction sector is just lagging behind, but also because of the uncertainty, because of so companies maybe were kind of waiting to understand which will be the impact of the following waves of the COVID, and how will their financial health be after the crisis. But we see that I mean, it's on the rise, it's recovering. And at the same time, we should also say that the repair and maintenance segment is doing very well. So we think it's just kind of a small lag, but that in a few months, this sector will do well too, because we know that households are asking for new houses, and at the same time that we can see also that maybe in industrial or commercial, the building permits are also on the rise. And on the other side, so if we look at exports, as I told you, the issue are not the goods exports, because as you can see in 2021, we are at higher level than in 2019, even thanks to all the sectors that are recording soaring prices, soaring demand, as Marcus has said, metals, wood, but also plastics, for instance, rubber, and chemicals, for instance, or agri-food. But at the same time, as you can see on the right chart, the international arrivals are still very, very low. Of course, maybe in some media you will read that, well, tourism has increased by 80% in July, but if we compare with a normal year, we were still in July 55% below the pre-crisis level. And it's because of all tourists from abroad, from all Europe, but even more, of course, from Americans and so on. Then what we can expect is that, as Marcos has shown in the first slide, that the vaccination rollout has been very efficient in Spain. Spain is among the biggest countries, the first one to reach 70% of population fully vaccinated. So it means that we can expect kind of back to normal life in Spain, and so that tourism will recover quite strongly, and maybe by the end of this year we'll have higher rates than last year, of course, but even maybe go back to 2019 levels too. So let's say that the outlook for the tourism sector is maybe not a full recovery over the next months, but we can be kind of positive thanks to this very efficient vaccination rollout. And if we look ahead to, the outlook depends on consumption, on households, and also on the labor market. And if what we are it's what we are seeing here. When we look at the unemployment rate, as you can see, the number of unemployed people is falling down, almost back to pre-crisis level. At the same time, the employment is on the rise too, as you can see, with these employees affiliated to the social security system, already back to the pre-crisis level. And what is interesting is to see that, well, it's thanks to the industry, because as we say, the industry is doing well in Spain. It's not the issue, maybe except for the automotive sector, but it's a global thing, that the automotive sector is definitely limited, the activity is limited by the supply shortages. And at the same time, you can see that the construction sector is hiring a lot, and they will even have some labor shortages, because activity is getting strong, as I said, thanks to repair and maintenance, and thanks to some segments of new works. But when we look at insolvencies, let's say that Spain is kind of an outlier, because we haven't shown you the whole figures, but all around Europe, insolvencies have been very low, around 30–40% below the pre-crisis level, the 2019 levels. In Spain, not. It's what you can see here. From last year, the figures were quite normal, and this year they are higher than before the crisis. And first, it was only because of the hospitality sector, and this was due to the fact that the direct support measures were maybe lower than in the rest of Europe in Spain, and also that they came later. So even though they were maybe allowed to stay open longer last autumn and last winter than in the rest of Europe, they recorded increasing insolvencies. And also right now in 2021, we should say that the rest of the sectors is also recording higher insolvencies. Is the case, for instance, in the construction one, with trade to be an exception. So we will have to be careful regarding the retail sector when the suspension of the obligation to file for insolvency will expire, and it's expected to expire by the end of this year. Then we'll see what kind of measure the government will take to try to maybe, let's say, mitigate the impact of the increase in insolvencies. But of course, we are seeing that very, very low insolvencies in the retail sector. So we have to be careful about that. And to finish, in Spain, the hot topic is the inflation. As you know, the energy prices, well, Marcos has explained to you what happened to the natural gas prices, and this is the one factor that is leading to very high and soaring electricity prices. And well, what you can see here is that so far the core inflation is remaining quite low. The last figures for the inflation of September has just been posted, 4%. So it's huge, of course, a huge increase. But at the same time, so far the core inflation, so if we exclude energy sector and food product sector, it remains kind of low. So then we'll have to understand, as Marcos said very well, to see if the wages will follow or not, if we'll have second round effects or not. And just a thing just to explain to you what is happening to the electricity sector in Spain is that the sector is very dependent on the gas production, the gas sector, because what happened is that they've invested a lot in renewables energy, but that are some intermittent. It's what happens with the wine sector and also the solar sector, for instance, because if there is no wine, then it looks like you cannot produce, and even more if the demand is high. So then to respond to the demand, you have to produce with gas. And we know that the wholesale market in Europe the wholesale market price depends on the most expensive energy. So in Spain, it will get very quickly to the gas production, and as the gas prices has increased, it looks like the electricity price will remain high, despite the fact that the government has extended until next year the decrease in taxes in the energy to try to mitigate this increase in prices. But we can expect the energy prices to remain high for quite the next months, and inflation to remain high too, but with core inflation maybe remaining below the 2%. So then it's only a temporary factor, as Marco said very well. Now, if we move to Portugal quite quickly, here the situation is similar and different, because similar in terms of the fact that exports are also low, but when we look at exports, once again, we are talking about exports of services, of tourism, and you can see that international tourism is also remained very low in Portugal, because foreign tourist arrivals have declined by 68% in July still. And well, what you can see is that it's still very low, but with the vaccination rollout, very efficient. Portugal is a country in the world with the highest ratio of fully vaccinated people. We can expect the tourism to rebound too. The other factor is that the construction sector is quite buoyant in Portugal. This is the main difference between Portugal and Spain, is that construction sector hasn't even recorded a fall in activity last year. It's really surprising. It's definitely a difference with the rest of Europe. But of course, the other sector that are suffering is the hospitality one, right? And when we look at the industrial production, we can see that investment goods are falling down. Why? Because of automotive sector, for the same reason we've explained before. And the sector that are doing well is the consumer one, but also the durable ones. And why? It's thanks to household appliance, because as you know, as I said, people will stay home and then they just want to invest to buy new products, new household appliances, to be well at home. It's called homing, and we think that it's a lasting trend. So definitely, I mean, there are very uneven trends in the Portuguese economy. But if we look at the outlook, it's also positive, I think, and maybe even more than in Spain, because as you can see, basically the employment is even higher than before the crisis. Unemployment is getting very low too. So we can expect the consumption to rebound. But of course, when we look at the employment by sector, we can see still some huge differences. But what is interesting, I think, is that industry and construction are doing well, are even higher than before the crisis. But so we have kind of a margin of improvement in services. And when tourism will be back, and so the hospitality sector will be, and they have been allowed from tomorrow to reopen, fully reopen without time limits and so on, and without even health passports in restaurants and so on, we can expect a strong rebound in these sectors, in these industries, and so let's say a positive outlook for the Portuguese economy. That's all for me. Now I leave the floor to Celtem.
Thank you, Marco. Thank you, Bruno. Sorry for this interesting presentation. And I leave the floor to Celtem.
Hi, and thank you for your attention. And so I'm going to start my presentation with the GCC countries. After contracting 4% last year and 3% in the first quarter of this year, Saudi Arabia's economy shifted to expansionary territory in the second quarter as it grew by 1.8%. But this didn't avoid the economy to contract by 0.7% in the first half of this year. And in the second quarter, oil sector continued to contract by 8%. But we consider that non-oil sector will continue to support the economy. Indeed, actually, manufacturing sector expanded 14% year-on-year after it grew by 12% in the first quarter. The retail, trade, and transport sectors provided higher contribution to growth, while the growth in construction remained restrained at 3% for the second quarter of this year. The UAE's economy was hit by a double shock in 2020. This was first related to the collapse of oil prices following the disagreement between Russia and Saudi Arabia in March 2020. The second being the COVID-19 pandemic. According to preliminary estimates, the UAE's economy contracted by 6.1% last year. However, the outlook is brighter for this year, as Coface expects growth to stand at 3.1% this year, thanks to a fast vaccination process and a sharp recovery of the global economy and the rebound in energy prices. Well, the non-oil sector benefits from a favorable base effect, a fast vaccine campaign, which in turn support the consumer and business confidence. Although there was a slight decline in the PMI index in Saudi Arabia in August, businesses still benefit from demand improvements and the easing of travel measures. And in the United Arab Emirates, companies still express there's an expansion in output levels aligned with rising new orders. And companies also expect Dubai Expo 2020, which will start in October after a year of postponement, would drive investments in the coming months. A drag on this outlook would be related to the supply cuts in oil sector. As of August 2021, the crude production of the UAE stood at 2.7 million barrels per day, compared with 3.1 million barrels per day in 2019. Saudi Arabia has produced in the same period by 9.5 billion barrels per day, compared with around 10 million barrels per day in 2019. Having said that, we see that oil sector has started to pick up in the third quarter compared with the previous quarter, when oil production was down by nearly 1 million barrels per day for Saudi Arabia and 300,000 for the UAE. In the months ahead, we expect that oil production would increase further thanks to the OPEC Plus group agreement to increase oil production by 400,000 barrels per day on a monthly basis. Well, this brighter outlook seems to vary across the sectors. We expect performance in tourism, construction, and retail to be closely in line with new variants of the virus. Expo 2020 is expected to attract tourism inflows into the UAE. Indeed, we consider that the tourism would be the first sector to experience the positive impacts of the quick vaccine rollout and lifting of the pandemic-related sanctions. Due to COVID-19, international arrivals in the UAE are estimated to have collapsed by around 70% last year. And given that the sector accounts for around 7 to 8% of GDP, it would have an important contribution to the overall growth. Around 35% of total tourist arrivals in the UAE are from Asia Pacific, 27% from Europe, and 26% from the Middle East. So once these key source markets reopen and visitors are vaccinated, the tourism sector will rebound. However, pre-COVID-19 performance is not expected to return immediately. Other than this sector, retail and transportation sectors will also benefit from the economic recovery. On the other hand, the construction sector will need more time to recover, as it will continue to suffer from fiscal discipline and a flight from expatriate population during the pandemic, and the office and the downward pressures on the office segment, as well as on the retail subsegment. Well, in Saudi Arabia, the pandemic seems to be under control. On the second chart, we can see there is a double-digit increase in credit card spendings. Kingdom may loosen also its fiscal policy in line with the rising oil prices. This would have positive impact on the consumer confidence and private spending. Saudi Arabia's budget deficit narrowed to around 5 billion riyals in the second quarter, which was boosted by higher oil prices and surge in tax revenue in line with the economic recovery. Having said that, the budget deficits of the GCC countries have widened during the last decade. However, with the measures aiming to achieve fiscal discipline and the economic recovery, we consider that these deficits are expected to narrow over time. The current spot oil prices has recently climbed above the fiscal break-even oil price for most of these countries. For example, for Saudi Arabia, this price stands at $76, while for the UAE it is at $65. So as a result, the fiscal deficit is expected to narrow across the region to 3% in 2021 and to 1.5% next year from around 9% last year. On the other hand, there is a rising competition between the UAE and Saudi Arabia over their economic diversification strategies and hub status. At the July 2021 meeting of the OPEC Plus, this strong opposition from the UAE to their reference base resulted in a confrontation between these two countries. And although the disagreement was solved within the following days, bilateral relations remain relatively fractious. Saudi Arabia, whose economy depends more heavily on oil than the UAE, has implemented the Vision 2030 strategy that aims at a national economic transformation to become a business and trade hub in the region. And on the other hand, although the the size of the UAE economy is around half of the Saudi Arabia's economy. The country is able to attract almost an equal sum of capital flows from abroad. So in recent years, this situation has led Saudi Arabia to challenge the regional hub status of the UAE. And in February 2021, the kingdom announced that it would cease its contracts with the companies that have their regional headquarters not located in Saudi Arabia. But still, we consider that these conflicts would remain limited to the economy. And on the political front, they are expected to continue being allies, particularly in an era marked with uncertainties over regional stability. Well, coming to Israel, Israel's economy grew an annualized 15.4% in the second quarter from the previous quarter on the back of big gains in exports, consumer spending, and investments. Exports rose 18%, while private consumption rose 36%, and investments nearly 10%. We expect the rising international trade volumes and the fast vaccination process in Israel will help the economy to be among the best performers in the region, with a growth rate of 5.5% this year. Although the business confidence index showed a slight decline, as you can see on the second chart in August, it still stands well above the bottom it hit in the second quarter of last year. And this trend is expected to continue as long as the global trade volumes and domestic demand remain resilient. On the other hand, although the coalition government remains fragile, it is now expected by many political analysts to remain in power at least until 2023. And early in August, the Israeli cabinet agreed on a 14-month budget, which was an important indicator showing that despite its character including different political fractions, the cabinet was able to come together and take a common decision, and this has supported the investment sentiment and helped the shekel to strengthen. And however, although private consumption is expected to add 4.3 percentage point to the growth this year, which is well above its average of 2.3 percentage point between 2015 and 19, thanks to the rebound in consumer sentiment and improvement in labor markets. The Delta variant may weigh on the pace of private consumption growth. Indeed, the sudden outbreak in mid-July caused a sharp implementation of new regulations from the government side. And with these new regulations, the government has limited capacity of stores and shopping malls and etc. As a result, we expect these impacts to be felt in the third quarter GDP figures. And finally, net exports may represent a drag on growth performance. Indeed, a jump in domestic demand and investments lead to a surge in demand for foreign goods, and also global shortages of semiconductors would weigh on the manufacturing production, particularly on high-tech good output for the producers. Welcome to Turkey. In the second quarter of this year, economic growth in Turkey came in at 21.7% year-on-year, in line with the market expectations. In the first half of the year, GDP grew by 14% from a year earlier, and the industrial production rose 25%, while services expanded by 24%. We expect Turkey's GDP to grow by 5.7% this year as of second quarter. However, there are significant upward pressures on our forecasts. If we look to the second graph, we can see that the industrial production keeps its strength as it grew by 20% in the first 7 months of the year, despite the global supply shortages. The growth is spread across all the sectors, but the rise in commodity prices and transportation costs can be a drag on the further expansion of the industrial production, as the increase in those two factors would increase the production cost for producers. Or the producers will have to pass on onto the consumers these higher costs, or they will need to reduce their profit margins. The current account deficit continues to narrow in Turkey despite the strong growth performance, and this shows that the macroeconomic outlook is now more balanced. In the first 7 months, the current account deficit narrowed to $14 billion from $23 billion in the same period last year. And the core deficit, which excludes gold and energy, has produced a current account surplus of $6 billion since the start of the year. Tourism revenues rose to $6.5 billion in the first 7 months of the year, compared with $3 billion last year. And on the financing side, direct investments have slightly recovered, but they continue to remain relatively weak. Turkey was able to attract $3.6 billion of FDI at the time, in the first 7 months, compared with an inflow of $2.6 billion last year. On the portfolio inflow side, Turkey was able to attract a total inflows of around $4 billion, compared with an outflow of $15 billion last year. So we expect the current account deficit to narrow to 2 to 2.5% of GDP this year, compared with 5% last year. But rising commodity prices and uncertainty related to the pandemic may weigh on the pace of narrowing of the deficit. Well, you can see on the second table that how actually Turkish exports performed well this year. In the first 7 months of the year, exports rose 35%, compared with the imports that rose 25%. And for the first time in Turkey's history, Turkey has recorded a trade surplus against the US and EU 27 in the first 7 months of the year. So $1 billion of trade surplus against the US and $1.7 billion against the EU 27. Well, although we are optimistic about Turkish economy's growth and export performance, risks around the uncertainty in the monetary policy, inflation dynamics, and high level of debt persists. And Turkey's central bank recently cut its policy rate by 100 basis points to 18%, while the headline inflation runs about 19%. We estimate headline inflation to stand at 16.1% at the end of this year and around 11% at the end of next year. But risks are on the upside on our forecast, given the loosening of the monetary policy, rising commodity prices, and the stickiness of the inflation, especially in the service sector. We also notice the inflation expectations are deteriorating towards 30% for 12-month inflation from 11% a few months ago. Well, the increase in borrowing resulted in a rise of the non-financial corporate debt levels above the average of emerging markets. As per Fitch Solutions, non-financial corporate debt was equivalent to 120% of GDP in the last quarter of 2020, compared with an average of 100% only between 2015 and 2019. Well, in Turkey, we see that the external debt is widening, and short-term external debt now is equivalent of 20% of GDP as of the first quarter of this year, out of which 13% belongs to the private sector, and 80% of this actually belongs to the non-financial corporates. But despite this widening of the external debt, we consider that chances for current account balance crisis are very low in Turkey, and the long-term rollover ratio of the Turkish banks stand at 92%, and other sectors stand at 112%, which show that the companies and the banks are still able to roll over their external debt very easily. So it's going to be the end of my presentation. Thank you all for listening. I'm going to leave the floor to Antonella.
Thank you, Seltem. Thank you to all our economists for this interesting update, and thank you all for your attention. Now we jump quickly in one question for Marcos. Marcos, Italy, Spain, and Portugal were once part of the acronym PIGS. Now the government's reaction to pandemic necessary has frustrated the efforts to make and keep the public debt under control. Do you think there could be any consequences for this economy?
Well, it certainly does not put them in a comfortable situation. So just to remind a little bit the context of this, that acronym of PIGS came into the debate during the last Eurozone crisis of the start of the last decade. And as a way to kind of like denounce fiscal irresponsibility in these countries, which may or may not be the case. You know, Spain, for instance, had a very low public debt before the crisis. But anyway, the point is that they all pretty much have now pretty high public debts. You know, around 160% of GDP for Italy, around 200% in Greece. And well, once you get to that point, it's very difficult to make it to come down. But I think that what these European countries and Europe as a whole did very well last year is said that, well, really the only good choice to make these come down is to invest in long-term growth and to create the fiscal and monetary conditions in order to, you know, not only support growth on the short term with these investments that support aggregate demand, but also improve the growth potential of these countries, so that after the pandemic and after the rebound is done, like we're growing at 3% rather than 1.5% or 2%. And so when it comes to debt sustainability, this is why I had spent so much time on inflation and debt, because whenever you hear some officials saying that despite, for instance, Italy's very high ratio of debt to GDP, debt is sustainable, what they mean is that, well, the amounts that we owe, that the country owes, are very large, but what we have to pay on a regular basis, what we call the debt service cost, are pretty small, considering that, and are manageable, considering that interest rates are very low. And that's why the answer to that question of if public debt is going to be an issue or not really depends a lot on what the inflation picture ends up being. So I think that the best thing that these countries can do is to keep doing what they've been doing this year and a half that's been going on. It's just like good diplomacy at the level of the European of Europe. You know, hope that support for this new European consensus remains in the northern countries, and be very careful and very smart about how that money gets invested. Make sure that it goes to long-term growth as they have been doing. But also, if, like I said, inflation turns out being more durable than we expected, then I don't know what's going to happen. Honestly, I think that the ECB is going to take a lot for them to raise those rates. But if they have to raise those rates, then they will be in a dangerous situation. We're not there yet.
Thank you very much for this answer. I take also the opportunity to thank you because Marcos has an important meeting now. He has to leave, so thank you for your presentation and your help for this webinar. See you in the next one.
It was very useful to you. Ciao.
Ciao. I jump quickly to Bruno. Bruno,
Yes.
automotive is a major sector in Spain. How relevant is the impact of energy, metals, component, and logistic issue on the Spanish producer? And what are the consequences for the Spanish recovery?
Well, it's very relevant. At the beginning of the presentation, Marcos showed us a survey that was made in Germany, but it could have been made everywhere, in Europe and even in the US or even Brazil, because we are seeing falling automotive production everywhere because of these issues. Let's say the supply issues, semi shortages, logistic issues, higher costs, and well, we know that, for instance, the automotive industry was the one that recovered maybe very quickly at the end of 2020. It was one of the driver of the growth, but we know also that, well, is the industry that fell down. And so, yes, definitely, it had a huge impact. It had a huge impact in Spain too, because, for instance, when I talked about the goods exports in Spain, the rising good exports, I didn't mention the automotive sector as a driver. So yeah, definitely, it's one of the sectors that has dampened the exports of Spain over the last months, the activity too. So yes, basically, it's waiting on the recovery of the Spanish economy. But well, then what we think too is that the Spanish automotive industry is one of the most efficient in Europe. We know that if one industry has to grow, it will be in Spain. So when the activity in the industry will recover, because we know that it's not an issue of the demand, right? It's an issue of supply. So basically, we think that the production is just being postponed because of this lack of inputs. But well, with time, as Marcos said, the prices are expected to, let's say, to soften, and so we can expect then the automotive production to resume over the next year, and then we think that the Spanish automotive sector so far, I mean, for the moment, is not in a good position, but as known is at a global level. But then we think that it's not an issue, a structural issue, but more, let's say, over the next quarter, it will improve. But it's true, quite gradually, because these supply issues, as Marco said, I mean, they will last until at least the first half of 2022.
Thank you. Felten, I jump quickly for you because time is running. Dubai export will impact positively tourism revenues, you said, but what are the consequences and how the economy of UAE will perform after this important exposure, Dubai export?
Yes, actually, we are quite positive about the UAE's economy. While Expo 2020 represents just a part of it, of course, it will have an impact on the other sectors such as construction and retail through the higher number of tourism arrivals into the country. However, this is not the only pillar, this is not the only event that would have a positive impact. We know that still, although the UAE's economy is relatively diversified. Actually, it is the most diversified in the region. 30% of GDP still depends on oil. So every recovery in oil prices would be helpful for the economic growth to have a brighter outlook. On the other hand, we see that the non-oil economy has also started to recover, as long as the vaccination process will continue and the economy, not only in the United Arab Emirates, but all over the world, the economies will remain open. This would support the the UAE's economy as well. Plus, the rise in the global trade volumes will be important because the UAE still can be considered as an important oil exporter, and so as long as the global trade volumes will continue to increase, this will help to sustain the economic growth in the UAE through export channels.
Thank you. One question for you. Do you expect an impact from the local election of last Sunday in Portugal, Bruno?
Oh, yes. Well, I think that one surprising result was the fact that the ruling Socialist Party has lost in Lisbon. It's true we're not expecting it, but at the same time, I mean, in the whole country, the Socialist Party has still won in many councils. So let's say that it's the winner. It's not the winner as we expected it to be. With a large margin, because it's true also that the timing was really good for Antonio Costa, the prime minister, because I mean he just announced that everything would reopen and life would get back to normal few days before the elections, and at the same time that the vaccination rollout. I mean, the results are very good, are very efficient. So the economy, as I said, is recovering. So we were expecting it to be the best timing for him, and expecting just a wave from the Socialist Party. It has not been the case, as I said, even more in Lisbon. But at the same time, let's say he's still the biggest party in Portugal. So we don't expect it to be threatened or jeopardized over the next month. So let's say, yeah, the results are not as good as we're expecting them to be, but let's say not that bad either. To
not
really
bad news.
exactly to lead to huge changes.
Okay, thank you. Last question for you. Have exchange rate and rising prices produce any visible effect on payment behavior of Turkish company? We saw some increasing of insolvency in Spain, not in Europe. What is the situation of Turkey?
Well, so far we haven't noticed any deterioration in payment behaviors in Turkey. Actually, as long as the depreciation of the lira is not happening in the form of a currency shock, producers, I mean companies, are able to adjust their financials to the depreciation of the lira. So actually they are kind of used to live and function within such an environment. And so far they were able to absorb the rise in commodity prices as well, because the domestic demand and external demand were quite high. So this gave the possibility to the companies to pass on to the consumers a part of this increase in production costs. However, in the upcoming period, with the stabilization of the global growth and further increase in commodity prices, well, the situation may start to change for producers, not only in Turkey, but almost everywhere in the world. As I mentioned during the presentation, the further increase in commodity prices may push producers or to continue to increase their final sale prices, or reduce partly their profit margins. But we don't consider for now that these factors would have an impact on the payment performance of the Turkish companies.
Thank you very much. We have other questions that we will answer through via email. Thanks to our economist. We are now closing the webinar. Thank you for participation again. You will receive the presentation, the recorded version of this webinar. And I invite all of you to visit our website in order to be informed to our publication and follow us to our social media. I really thank you, and I remind you that we are here to building business together. Thank you very much, and we will have another webinar before the end of the year with our economists. Thank you, Selten. Thank you, Bruno.
Thank you so much.
Thank you.
Muchas gracias. Bye.
Bye bye.